Ladies and gentlemen, thanks for joining us today. We're going to wait just a few more minutes as the attendee link is now open and they're starting to really climb. So just give us a moment or two so we don't miss any introductions as we get ourselves settled. Your panelists are all ready for you, and just give it a moment or two. New York. Good afternoon, Queens. My name is Tom Gretsch. I'm the president and CEO of the Queens Chamber of Commerce. We are the oldest and largest business association in Queens County, been around since 1911. And even with this pandemic, hope to be around for another 100+ years as we go into the future. Obviously, these are very, very difficult times. And I don't need to tell you how much of a challenge it is out there to operate, be it as a tenant or a landlord or a property manager, etc. But I'm going to just say a few remarks before I turn it over to our co-chair of the Queens Chamber of Commerce Real Estate Committee, Michael Wang. So one of my comments is all the things that were in place when Amazon decided to come here a couple of years ago and then sadly subsequently left, all still exist. So whether it's transportation, whether it's diversity, whether it's access to really, really smart people, we have 8 colleges and universities in Queens County, 70,000 plus matriculated students. Queens College graduates more computer science majors than any other school in New York City. We have it all here. And to that end, in order to encourage investment and development and supporting our real estate community, we started a Relocate to Queens effort. It's relocatetoqueens.org. You can go to that website. You can find it on the Queens Chamber website as well. But again, that's Relocate to Queens. And one of the things I want to tout today is, and it's under assault by some quarters, are the Treasury Secretary Mnuchin's plan and idea that was put into effect about a year ago and revised in January, are the economic opportunity zones, federal opportunities within our country that allow people to invest at a great tax advantage in certain areas. Very proud to tout that in Queens County, we have 63 economic opportunity zones in financially distressed areas. It's really, really important that you go to our website and learn exactly where they are for property you may already hold and own, for property you are seeking to buy, and for property you're seeking to build upon. That's my pitch for Queens County. Our panelists are all committed folks. Very pleased to have them today. And just want to, again, thank each and every one of them, as well as all of our participants for today's event. You have any questions at all, go to the Queens Chamber of Commerce, call us at 718-898-8500. And again, to our panelists, to our investors, to our business people, the best is yet to come in Queens County. And with that, I want to turn it over to our chair, who's our moderator today, the one and only Michael Wang. Michael, it's all you, and thanks a million.
Thanks, Tom, for the introduction. Thanks, everyone, for coming. Welcome to the Queens Chamber of Commerce. My name is Michael Wang. Real quick about the Chamber, it's a great organization. They host tons of events every year, and there's tons of member committees. So there's real estate, energy, healthcare, arts and entertainment, and a bunch of other things. So for those of you that are new to the Chamber, check out the website and see how to get involved. Today is the Real Estate Committee, and we want to share our knowledge of the Queens commercial real estate market. I think it's safe to say that every segment of business has been impacted by the pandemic. And now that we're reopening the economy, the pertinent question in real estate is where do we stand? So, what does the market look like? We're going to do our best today to address those questions. We have an amazing panel, and we'll be doing a Q&A after. There's a Q&A box in the Zoom, so you can type your questions at any time, and we'll get to it when we can. I'm going to turn it over to the panelists now to introduce themselves. Stephen, you want to go first?
Sure. Thank you, Michael. Happy to be here. Vice Chairman of Cushman & Wakefield Capital Markets. I focus in the outer boroughs, and I head up the Queens office as the market leader.
Jerry?
Yep, Jerry, Pi Capital Partners. We're one of the landlords here in Queens, predominantly Jackson Heights, Elmhurst, and Flushing.
Kevin?
Hey, good afternoon, everyone. I'm Kevin White. I handle the Queens market for CoStar and LoopNet. So all the tracking information, I've been handling the market for about 4 years now.
So we have a lot of great perspectives from broker to owner to big data. And I'll be moderating. I founded a company called Project Queens right before the shutdown. And it focuses on commercial real estate in Queens, where you do a lot of leasing. And it looks like we're going to be doing a lot of maybe off-market transactions and whatnot moving forward. So I think we're ready to begin. You guys ready? All right, awesome. So this is exciting for me because I'm asking these questions not as just like a scripted moderator. I really want to know what's going on. This is my profession, and I need to know what's going on. The panelists really know what they're talking about, and in a real estate market that's so wide and has so much depth, there's no way for one person to know it all. So this is really awesome. We're going to start with a macro overview of the Queens market, and after we get that overview, we'll start breaking down the different product types and whatnot to see how they dig into the more specifics. So this question is really for all the panelists, and feel free to jump in whenever you want. What is the state of the real estate market in Queens right now? And where do you see it going towards the end of the year in general?
I'll start, Michael. So overall, compared to March or the second part of March, April and May, we're in a much more favorable position. I think in the overall context of a market cycle, we're still hitting our footing. We're starting to see some themes, though. We're starting to see some really good momentum over the past several weeks to 2 months. There are people on the phones again. There are offers being had. There are contracts being signed, and we expect closings to trickle in as they come. Unfortunately, we're not going to see a lot of comps, post-COVID comps, for some time. So it's really about the market breadth, which I think we can all speak to, the panelists here. We're seeing some common themes as far as what assets are trading, what they're trading at, what price points and discounts people are expecting, and what discounts sellers are willing to give. So I think overall, we're in a good momentum cycle. I hope that will continue throughout the balance of the summer, and especially into September, which I think is going to be a real time of consequence, and as far as the last 2 quarters of this year. But overall, we're still really gaining our footing, but it's encouraging to see a lot of the momentum that myself and my team have seen over the past several weeks.
All right. And from a landlord's perspective, collections have been stabilized. Throughout the entire COVID process, the collections for residential has actually been pretty stellar. We have to admit, we have a combination of rent stabilized and free market units. Annualized income collections were down probably on an annualized basis about 3%. Looking at some of the other important figures, one of the most important figures we looked at among residential rentals was 38%. And what 38% represents is that's the percentage of tenants who either did not renew, or percentage of tenants that requested some sort of rent relief. So ironically, and that, compared over in 2019, 2018, that number is actually kind of flat. So that's the good news. And I just got the figures this morning from June and July. Even in July, rental collections for residential is about 95%. So, and we're a couple days away from July, we're about 95%. June, we were about 100%. So residential is good. On the retail end, the good news for Queens is that every retail store that we have had is open. And certainly from the landlord's perspective, the big thing we want to do is keep guys open. on the retail end. And the good news is that Jackson Heights, Elmhurst, Flushing have all performed much better than Midtown Manhattan. Midtown Manhattan is a difficult market right now. And, and finally, probably the weakest performing sector for us has been office. Office, right now everyone's working from home, which is actually benefited residential, but hurt the other sector for office.
Just from the data perspective, yeah, kind of going to Stephen's point, we've seen month after month going back. So July already outpaced June, June outpaced the months prior in terms of actual closed transactions. So we see the market moving. One unique thing about CoStar is that we have LoopNet as part of our portfolio. So LoopNet tracks activity. We've seen the activity. So these are tenants in the marketplace actually going out there searching for commercial real estate traffic go up as well. So the market is moving, like they said. We are seeing the indicators, and it's just a matter of how we progress throughout the year. But we are moving in the right direction, which is good, and I think reassuring for most everybody on this call. And I think we're all starting to see it as we go.
So for me, I just got back into the office maybe like a month ago, and I'm trying to get everything up and running. And I was coming back thinking, all right, I hope it's just like not dead. I hope there's some activity. And, I'm experiencing the same thing. And when I speak to, other people in this industry, everyone's saying the same thing. Like the market, I mean, it's weird, almost weird to say it, but it's like, is the market like hot right now? So in terms of all this activity, what kind of buyers in the market? And, what are you seeing in terms of, let's go with the buyers in the market. Like, what kind of buyers are you seeing? Like, what's their, I don't know, can I even say profile these days? What's their profile?
Sure. Good question. I wouldn't say the market is hot, but we are seeing fluidity with a certain sector of the market or a certain sector. So what we're seeing right now, and this is a trend that's emerging on a daily basis, is that we're seeing small to mid-cap properties are the ones that actually transact and are voluminous at this point. Small to mid-cap being, from a couple $1 million, up to about $25 million. We're seeing the higher priced product really be stagnant and really not getting the traction that it was, let's say, pre-COVID. And some of the reasons we think are because of this is that the institutional buyers are really stuck in the mud. They're not able to navigate some of the red tape and bureaucracy, partnership approvals, board approvals, and the many steps that they need to go through to deploy that capital. On the other hand, what we're seeing is that the typical Queens buyer, let's say, are the ones that are really carrying the volume right now. These are the people that are generational buyers. These are the groups that own a few properties. These are the small family offices that can make a unilateral decision on their money to purchase, and their outlook is more so on a 10 or 20 or even a generational aspect. So these types of buyers are looking at more of a long-term stance, and their mindset is that if I can buy this core product, if I can buy this product that I would have bought a year ago at a modest discount, which are the discounts that we're seeing in the marketplace, we're not seeing 40 or 50% of distressed product at this point in time. But if they're looking at it at a long-term basis and saying, I can buy my core product, this property that I could have bought or willing to buy 6 months ago at X amount, and I can buy it at 10 to 15% discount to perceived par, and I don't have to really compete against 10, 15, 20 buyers, I'm willing to buy it, and I'm willing to take a long-term approach. So the local mom and pop buyers are the ones that are really moving the market on the small to mid-cap properties.
So, I think the assumption of just like in general is something like everyone's going to want a deal right now, or everyone wants a discount. And in my mind, I've always thought that there's in between that huge discount and the market price is a huge amount of capital from local generational families, mom and pops, single buyers, and the institutional. There's a huge amount of dollars that would purchase these products at this less of a discount. So, so that makes a lot of sense to me. So, do you see these kind of do you see big discounts, or is it just, you know, how is that going?
At this point in time, we're seeing modest discounts. We're seeing 10 to 15% for the most part on the transactions that are actually coming to fruition. We have not seen large discounts at this point in time, and part of that is due to a lot of the subsidized monies that people are receiving. They're able to kick the can down the street a little bit more. The New York City and state process as far as getting to a foreclosure or being a for sale is a protracted process. Commercial real estate as a whole is a lagging indicator. So I think we'll see more larger discounts or forced discounts or corporate backed asset discounts later on in the year. We just haven't seen them just yet. And a lot of that small to mid cap type of product, they're, for the most part, obviously everyone likes a deal and to get 30 or 40% off, but we're seeing the longer term players be happy and transact on that 10 to 15% discount, which is really the threshold that we're seeing sellers be okay with at this point in time, as opposed to the people that eventually will have to sell. And we may see some larger discounts in the third and fourth quarter, but we haven't seen them yet.
Kevin, is there any data that you see that backs this up, or do you need more time to gather that?
It's funny, like Stephen is dead on. I think when I looked at the actual asking price versus selling price difference, it was like 12.1%. So like right in the sweet spot of where he talked about it, what we've seen so far. So a lot of that other stuff, like you were dead on. A lot of that other stuff, like he said, may be lagging indicators. And more stuff is coming on the market little by little. When we're looking at price reductions, they're not in large batches the way some people may think. There are, like you said, minor discounts occurring, but the data is backing it up and the market still moves. Some investors are taking the wait and see approach, as you know, there's some on the retail sector looking at maybe what rents are being collected, looking at things like that on certain properties. But like he said, it may bear out later in the year. We're starting to see more discounts emerge, but I think we're not quite there yet because of where we are kind of as things are still opening and hitting new ground.
I think this is a really important topic about the discounts. I'm sure a lot of the attendees right now, the mindset maybe, you know, I've been waiting for the right time in the cycle to make a big purchase, and they might be hoping for something bigger. So, Jerry, you're not only an owner, but you're also a buyer, right? Is there a difference in your mind state of buying now as opposed to pre-COVID?
Well, there's two phases right now. I think Kevin mentioned a really great point, is that, you know, with this COVID situation, we may not be out of it. And this is kind of looking at like 6 months, 12 months down the line. We're probably in the early stages of where we are with COVID in terms of the economic impact, just because of the fact we still have to make it through fall and winter. That's a big, I think people think that, you know, towards the end of the year, economic activity will pick up. But there's just so many unknown factors that we all just don't know. You know, if there's not a vaccine, then we have, or a situation where what if this picks up, you know, COVID-19, the infections pick up in New York City, what's that going to do? So from a buyer's, you know, we've been active, but we've also been very cautious at the same time because, you know, the market, I'm telling you right now that probably the next 9 months are going to be most crucial months, because what are we going to see with the unemployment rate come September, October? Especially with a lot of the government assistance starting to wear off. Are we going to see a second wave of layoffs? And more importantly, we haven't seen anything in terms of the white collar jobs yet, the impact on white collar jobs, which also will reverberate down to Queens. So, you know, right now, especially with a lot of deals that we're looking at, a lot of them are actually JV deals with owners. They tend to be large assets. You know, we're discussing, hey, we don't know, you know, what the prospects look like in 9 to 12 months. And I think it was just yesterday, Google probably jumped on the bag. You know, they see something we don't. You know, they're telling their workers, you're working until July of next year. So what is that doing with office space, basically? And I think they see things that, it's not going to get better for the next 9 to 12 months.
So kind of segueing into the different aspects of real estate that are going to become very important, how does the financing and the lending come into play? Because everyone seems to, and I might not be up to date on this, so I apologize, but it seems to me that the mortgage defaults, if there are going to be, haven't really kicked in yet, and that's a question that is scary to a lot of people if it's going to happen, like back in '08 or whatnot. Anyone have any comments about that?
Well, we've seen some commercial real estate debt themes come to light, and part of the reason that we saw really no volume in the first few months of the pandemic was not only because everyone was taking a step back, but because lending was not available, no matter who you are, no matter what phase of the process you were in, looking at assets or being pre-qualified or a letter of intent. The liquidity market just shut down. But we are seeing some green shoots with the lenders at this point in time. But the lenders seem to be cherry picking as far as what they're allocating their resources to, and they're really staying within their own family as far as the people that have relationships with that bank, and really digging into qualified sponsors to lend to. So as that opens up more, we expect that volume would naturally progress and increase. But again, we're at the early stages, like Jerry mentioned, we're at the early stages of this. So hopefully in September and October, that momentum will continue, and that will have a direct impact and carry over on the transactional volume.
I think too, from an underwriting perspective, when we're looking at it with lack of transactions kind of there, and then you also have with certain asset classes, people are worrying about possibly rent uncertainty or rent concessions. I think it's going to be a little bit of a challenge in the underwriting process to pull the data and see where we are, and that may, as you said, kind of put a little hesitance. But I think as stuff emerges and we are actually seeing deals done, hopefully it'll loosen some of that. But that's definitely probably more that you guys experience.
Yeah, certainly the financing right now, what we see is some of the CMBS products are starting to hit market. A lot of the some of the hotels in Long Island City are starting to kind of go into servicing. Right now, what we see till the end of the year, especially with banks and lenders, traditional lenders, is that they're just going to work on their own balance sheets. So can you get a loan? Yes, you can get a loan. However, even with the Fed rate near zero, we're not seeing very low. We're seeing historically low borrowing rates. But we've also seen that the underwriting has completely tightened for new acquisitions from traditional lenders, and almost across the entire commercial lending spectrum, lenders have put a floor on borrowing rates. So just because the Fed rate's zero, they're not going to be lending you 2% money. They've all kind of, they have their own issues. Lenders really have, some issues to work out with their own books. And they basically, it's going to run through the end of the year that they'll be doing some of these workouts.
So the activity that we mentioned earlier in this session, that deals are getting done at the 10 to 15% discount and activity seems to be pretty good. Does that mean these are more like cash deals, or is there financing in place for these?
We're seeing overall, we're seeing more cash deals come to light. Usually if it's a cash deal, they're going to want a little bit heavy over discount. We're seeing a lot more seller financing options to carry through. And those discounts will be a little bit more reasonable towards the seller. And we are seeing lending, but it's lending that, they're having appraisals done at lower amounts. It's appraisals that, or lending that they're requiring the sponsor to put 6 months escrow. It's more expensive, even though rates are low, it's more expensive for the sponsor or the borrower. So it's a combination of everything, but we're seeing more creativity all the way around to get these deals done and across the line.
that really was my next question, and anybody can answer. Do you see creativity in the new deals? And are deals being transacted like before? But I think you just kind of answered it. Like creative how? Like what? Because on the leasing end, I'm doing some things where traditionally I've never would have done before. So what kind of creative terms or whatnot are you seeing?
Well, seller financing being one. Longer closings are really the norm now, where the 30, 60-day closing, unless it's an unbelievable deal perceived by the buyer, or if they have a 1031, longer closings, 4, 5, 6 months are the norm. And what we do to combat that is maybe do escalated deposits. Instead of doing a large deposit up front, we'll scale the deposit throughout the longer closing period, seller financing again. So it really takes, for the most part, a little bit more creativity. It takes the sellers being a little bit more lenient on their terms. And again, not giving all favors to the buyer, but a little bit more lenient and thinking out of the box to be able to structure these deals in a time of flux.
Jerry, so I'm sure, and I don't want to necessarily dig into your business, but I'm sure you have tons of different renegotiations and things from your tenants. Have you been doing anything now that you really haven't done before to lock in some kind of stability and lock in some kind of path for both you and your tenants to thrive moving forward?
So for us, on a commercial end, we worked out most of our renegotiations back in March and April. And this is what we told our commercial tenants, is basically just to open back up. And that's held up well for Queens. So we don't have empty storefronts right now. So the good news, God bless, we actually, except for one space, and that's in out in Forest Hills, but across Jackson Heights, Elmhurst, Flushing, everything is open. Tenants didn't close. On the flip side, for residential, collections have been, and residential has really been the standout. I think throughout this entire crisis, residential has been the standout. There have been, obviously, it's case by case for residential, but what we've also seen is that a lot of the inventory we restrict. So what it means is that a lot of deals get done offline. So that's why by restricting, with the slight drop in demand, what we do is we also don't release any inventory. We try to work out deals with current tenants to have them stay, or they have some other people to come in to sublease their space. And most of our deals were kind of worked out back in, by the end of May, we had almost everything worked out. So right now it's just, new inventory that whatever new vacancies we get, just replenishing it. And for a landlord, the most important thing we do right now is to keep the spaces occupied. That's the most important thing. Whether it's like, you give nowadays, I guess it's pretty normal to give 2 months free for rent, which is fine. But we maintain the gross rent. And we see that if you take a look at Street Easy's dashboard out in Queens, you see that the median rents are the exact same in June of 2020 versus 2019. Inventory has increased. Inventory is at about a 2-year high. But part of it is this inventory was also backlogged from March, April, May, when nobody was showing. Keep in mind that the whole state was shut down. No one was doing viewings. So it'll be interesting to see where this rental inventory goes within the next 60 to 90 days for the market.
Yeah, just a funny side note. I was at my barber the other day, and he said when he opened back up, business was unbelievable, but that was a backlog, and now it's slowed down again. So, that's kind of relevant. When you say, Jerry, when you say open back up, just open, do you mean just open and we're going to figure it out later? Or? Yes.
Rule number one is that, people think we have a bad rap as landlords. The first thing we're trying to do is we're trying to keep businesses open. Especially now, trying to get a commercial office tenant or a retail tenant, it's very difficult to get one. Surprising thing is there are people looking for retail space. There are tenants looking for retail space. And now's the best time to look at retail space, but I'd rather work with the tenants that we have now because a lot of our tenants are all small businesses. And we're here to work with our tenants. I'm not here to, you know, put people out of business. We're here to start businesses with other partners.
And is that because of in the sense that you want to keep the cash flow going, and if they hit some sort of bottom line, then they just can't come back? Is that the thought process?
Well, the thought process is the lease up time is going to be extraordinarily long. Vacant space right now, if I have well, it depends. But for example, office, I can anticipate at least about, you know, 4 to 8 months vacancy to try and fill an office space. Retail, fortunately, Queens is stronger. Queens is much stronger in terms of the retail traffic. That we still anticipate about 4 to 6 months of vacancy. So my carrying charges for those 4 to 6 months is much higher. You know, it's a huge carrying cost just to have a space sit empty for 4 to 6 months, rather than just give this discount, give it to the current tenant, try to keep them alive.
So I want to segue into now the specific asset classes. If anyone has a comment of just the macro or anything in general you want to shoot out right now, feel free. If not, I'm going to start breaking down the different classes, and we'll go from there. Okay, cool. So let's go with this, Stephen. Because you work with all the asset types, what are the best performing or like the hardest hitting ones? And I'll just go from like best to worst, and we'll kind of trickle down into the detail.
So yes, we are evenly allocated across all asset classes in the borough of Queens. So right now, unequivocally, it's industrial. Obviously, that's been in trend, and it's been in a lot of the press lately. And just where we are in today's world, the last mile logistics, home delivery, you know, that's been a point of focus. We've seen that industrial has really been the only asset class that we can point to and say that their pricing and desirability has not changed, and it has even increased in some circumstances. As far as vacancy rates, and I'm sure Kevin can tell you the exact number, but vacancy rates on industrial are 3 to 4% in the outer boroughs in Queens, which is just basically like everything is filled, because there's always some tenants that are in a state of flux going from one property to the other, so which is an amazing factor. We have right now, I think, about 30 combined acres of industrial product that we're in process with marketing, either marketing or under contract at this point. And that is the only asset class, again, that we're seeing 10 to 20 offers consistently on our processes. So industrial is undoubtedly number one. We're also seeing some of the prototypical Queens assets really come to light, especially with the current pandemic. Mixed use, smaller multifamily. These are safe havens for most investors that are in the marketplace in the outer boroughs in Queens. The store with a few apartments above. And we really see a realigning of multifamily, where they've been very, overall, we've seen the multifamily market be hard hit, both on pricing and transactional volume with the new extremely strict rent regulations. But we're seeing people we're seeing the market reset on pricing. We're seeing sellers' expectations really level off. And now we're seeing the buyers really come back around to the multifamily because it is relatively a safe investment. The rent stabilization creates a floor, which there is a bottom line to where the property can pull in income. So we're seeing multifamily really circle back as far as a favorite. As far as the hardest hit, hotels, obviously. We were over hotel to begin with. As of last month, we have more hotels in construction coming to market than there are actually hotels existing in Queens, which is an interesting fact. And we were going to a place where we were at saturation already. So we've been seeing a trend on the hotel sector that they've been permutating use or changing use into other types of asset classes, whether it be homeless shelters or different types of program tenants. And I think that this pandemic is really going to explode as far as that continued repositioning of those types of assets.
Kevin, I would love to get the data side of this and see what you're seeing as well.
Sure. So starting with the industrial, central Queens area, like Masbeth, actually tripled its historical sales volume. Now, there's a large portfolio sale, 112 million, I think, for Sigtech Group. But that submarket area, vacancy went down. They had positive absorption. So that sector of the market and just industrial in Queens in general performed well. There was actually just a large deal in July that DY did for like 50,000 square feet in the area. So the industrial market in Queens, whether it be accommodating last mile, whether it be the distribution centers, has done well through this. So that's definitely a positive factor. The vacancy rate from Q1 to Q2, I think was up like less than 0.5%, which is marginal when you consider what may have come online. From the multifamily perspective, Queens has been on better ground than Brooklyn and Manhattan is relative. So you have like roughly 11,000 units under construction in Queens, with construction being halted for a little bit, and no like big shoreline, big, multifamily apartments coming online. Absorption remained positive. So, construction's back up. So we should happily, we'll see the vacancy come, but we've seen a lot of churn and a lot of increased activity in apartments.com and back to your renters looking. And there's reasons for that. You have either, economic factors where people are looking maybe to scale down, unfortunately, or just normal factors of having a roommate that you see maybe a couple hours a day, but then all of a sudden you're stuck in an apartment with them for 4 months. Like you're now like in a full-time relationship with them and you're fighting over the TV and the refrigerator. So like there's reasons for like maybe, more coming out. But as far as multifamily Queens out of Brooklyn and Manhattan, there are issues, but it's doing well. The absorption's there and, that construction's coming online. It should be good. And I think, like you said, what's transacting is the smaller end, the Ford, the Safe Haven, the typical Queens store on the bottom. The larger assets are a little more wait and see, but it's positive compared to its peers.
What about office and retail?
So the thing with office is lease expirations don't care about the pandemic. So there's always going to be transactions going on. I think like we always say, the lease expires every 7 minutes. So you're going to have, changes in the marketplace, whether some people are going to look for extra square footage because maybe 160, 180 square feet per person is not going to be enough anymore. Reconfiguration of spaces. There was like a study that came out, I think, over 50% of CEOs said they want the office environment back for the culture that it brings. So like coming out of this as we go, you may see some different looks at office space. Like you have Facebook rumors of the Neiman Marcus space, I think, in Midtown Manhattan becoming more there. But deals are getting done. You're seeing stuff get done. Vacancies creeping up a little bit. But I mean, you're talking about like 180 leases that are at least expiring. Maybe 200 leases are going to expire over the next year. So things are going to need to move. One thing is too, if people are going to be looked to be a little more conservative, Long Island City is going to be a lower cost alternative to Manhattan. So there may be, especially for Queens, and he brought it up in the beginning of this a little bit, there are incentives to move to Queens. And if for people that are looking for value in office space, proximity to the city, Long Island City fits that to a T. So I think long term, we might be looking at like a V-shaped recovery, but overall, I think there's positive signs that point to Queens as a good destination for a lot of that landing space.
But for office, do you feel like relatively to before the pandemic, it's slower or it's equal or faster?
I think it's a little slower. I mean, we saw some sublease space creep in at the end of Q2. You have like Macy's, I think, at the Jack's building, put some of that space on the market overall. So things slowed down. I mean, deals got done. Like I think Steven, you had like a pretty decent lease in like May for some square footage. Like I've seen activity trickle up month over month too. So I think as we're April was very slow, and then we've seen May, June, and July outpace each other's months. So we're getting, we're back on the road to people doing that. And as businesses shake out, I think we'll start seeing more leases creep up too.
Okay. Anyone want to add anything right now? So we only have like 20 or 30 minutes, and I want to kind of get into these asset classes. So we're just going to get right to it and do it nice and sweet. I'm going to make some assumptions here and tell me if I'm wrong. So warehouse, we'll start with warehouse. It looks like it's still pretty hot for all the reasons pre-pandemic. I'm not going to go into anything pre-pandemic. For all those reasons, it still seems like it's pretty hot. And I love how all the panelists we're coming from different places, but it looks like all the answers are aligning. Stephen, you hit this just before that. There's very little vacancy, 3.4% you said. So there's not much supply. Is there a lot of demand?
There's an overwhelming demand. We're seeing prices hold stable and even increase. For existing bricks, we're seeing prices in the $400 to $500 a foot range.
Yeah.
We're seeing, and that's you'll see the 500 even plus in some cases, more on the user end. If it's someone coming in to engineer the property and lease it up, you're probably closer to on the lower 400s, maybe high 300s. Just for existing land, we're seeing pricing from $150 to $200 a foot just for the existing land. And on the acreage basis, we're seeing some astonishing numbers where per acre, we're getting several $1 million, and in some cases, $10 to $12 million an acre for M zone land. And people aren't shying away from that number. And like I said before, we're running processes on over 30 acres. And the demand has been is quite notable with processes running 10 to 20 bids and really pushing the envelope on pricing.
So is this if I'm deciding to sell my warehouse, is it, hey, let's price it to the moon and pay me? And if I'm the buyer, is it like, well, you just got to pay it? Is that the play?
Well, there's a couple deciding factors. Location is a big deciding factor, as it is always, but the quality of the asset. It seems like most buyers are looking for quality and are really driving towards quality. So if you have proper ceiling heights, if it's an efficient building, if you have the proper drive-in doors and electric and things of that nature, you can go from 400 to 600 a foot. The ones that have low ceiling heights and really need a lot of CapEx, you could see those, the differential in pricing and the differential in overall volume of bids. So quality is the driver here, and location is important.
Any other comments on industrial? So let's go to multifam because it seems to be talked about optimistically here. I thought multifam got crushed last year because of all the rent regulations and other things. And Stephen, you mentioned that we're kind of reset the cycle, seller expectations to reset. It's always cool to look at the business cycle, and for me at least, and to see how that goes. What is the play here? So, because we're caught kind of in this recovery, I guess, how do you see sellers listing and pricing their properties, marketing their property, and how do you see buyers acquiring them? And this goes for anybody.
I'll start off, I guess. So we're seeing cap rates expand a bit. We're seeing cap rates for quality product in better areas really now stabilize in the mid-5s. We're seeing cap rates for secondary product, trend in the 6s, and then for tertiary product, cap rates have actually expanded into the 7s. We're seeing Class B multifamily really lead the way and is kind of the darling of multifamily at this point in time. Class A is getting some pricing sensitivity, people's income declines, and the influx of new construction also for that Class A is having a real impact. And Class C, the lower income to middle income, are really crippling with also the income levels and their jobs moving forward. So Class B in quality areas is really leading the way. I can see both on seller side as far as commanding the most depressed cap rates and on the buyer side.
Jerry, what's your outlook? Because the multifam, as your business.
Yeah, for multifamily, we anticipate pretty much the next 8 8 to 11 months, 8 to 12 months is going to be kind of like where we are right now, and that there's some instability. However, there's also on the flip side of this is that, we're actually quite hopeful because what we see is that there's a lot of reverse relocation now. People are coming back to New York City. They're coming into Queens. A couple of the biggest reasons, what we've seen from a lot of the renters, they're either relocating from more expensive areas of the city, or, ultimately they're here for the jobs. And I think that's the most important factor is that you're not, and these renters realize, while working from home is good, it's the new normal. Working from home 100% of the time is not feasible. And that's the big thing that we've realized is that these renters, what they want space. The number one thing they're looking for right now is that they want space. So they're relocating out of the, roommate share or, the smaller units, and they're upgrading basically. Because right now what they're finding out is they can basically spend the same amount of rent, get almost about 40-50% more space out in Queens. And more importantly, what makes Queens so attractive? It's the food, the people. And also keep in mind, Queens is a very diverse and cultural city. And for and what we've noticed, a lot of the people, they enjoy the culture, the diversity that Queens has, that none of the other boroughs has. This is the diversity of the demographics within Queens. And I think someone mentioned yesterday on Bloomberg was mentioned that was really interesting is that New York City, through this whole entire pandemic, what we're going to have is we're going to have people with young kids, families. They're the ones moving to the suburbs, but then you have the new graduates moving back into the city. So New York City on a whole, the workforce is going to get younger and more diverse, within the near future. And about, after this specific cycle passes, you'll find a workforce that's younger, diverse, and it just comes with the cycle, with how real estate goes.
So tell me if this aligns with how you feel, and tell me where I'm wrong. That I'm going to make this statement that 2 years ago, multifam was a very hot and very stable product because of all the regulations and whatever other reasons. There was a decline in the pricing, and now that per what Steven said, that the expectations have reset. Now you have people coming back, and it's like in a recovery. As an owner of a product and someone that's just kind of long-term looking at it, where in this cycle do you see us, and do you agree with that?
Sure. I mean, I would agree with that. I think overall that timeline is accurate. I think that we're heading into a period where we're going to continue to set and really trend the current pricing. And buyers and sellers have to really come to a meeting of the minds as far as where that pricing will lay. And I think right now, as far as lending, as long as lending continues to progress, we're going to see that uptick and increase in transactional volume for those multifamilies within those price ranges we discussed before.
Okay, let's jump to retail. So retail, it's in the news all the time. How do we see this playing out currently? All right, so I'll go a little bit. I do a lot of retail leasing, and for the longest time, you heard about the retail apocalypse and whatnot. But in Queens, retail does pretty well because there's a lot of mom and pop. There's a lot of local business that really needs to be here, and there's so much density that franchise and whatnot, they also want to be here. And what I'm seeing is that ever since coming post-pandemic, it seems like the quality companies, whether they're like Fortune 500 and doing well, or just the local mom and pops that have been doing well, are looking for space. So, Kevin, do you have any data points about that?
I mean, there's leases getting done. I think early last week, Marasia Bank leased like 11,000 square feet in Flushing, so they're taking space. There was like a 10,000 square foot retail lease in Rego Park. So the deals are getting done. We're seeing them trickle in. Volume's gone up every month. Looking at activity in the market, it's strong. Like the early engaging factors on LoopNet where people actually start their search, it's gone up every month and it stayed up. So I think like, you know, you have some issues where like some of the tourist income that maybe will hit Manhattan harder than it maybe will hit Queens. There's, like you said, with all the foot traffic and the people there, you know, overall there are challenges, but New York's, you know, pretty resilient in uncertain times. Like you see Astoria with tables outside, like Queens is still, you know, moving. So I think overall, while people are worried, I think Queens is going to fare overall pretty well. And it just shows in the deal volume and just what the market's doing.
I find that in the retail, so just to recap real quick, warehouse is hot just like before, and we have the standard type of negotiation in place. It looks like the multifam market, we're kind of like in the middle of a certain cycle, and you really need a meeting of the minds. For retail, what I've been seeing is that, and I'm not sure if these deals are going to close, but this is what I'm seeing. There's an amount of owners that are willing to make a deal, and then there's an amount of tenants that want to move into space. And I almost feel like saying it's cherry picking both sides to bring them together. And some of the negotiations that have been put in place are very interesting as well, in the sense that we're placing, let's say, lower upfront costs for the uncertainty, and then locking in like escalations to get back towards down the line. And it's like these kind of creative deals that are putting the market together, where I'm optimistic about activity. Would you guys agree with that, or do you have a different experience so far?
No, actually, I agree. I actually do see that with retail leases, you'll see probably some discount towards the first year, second year. A lot of the, as you guys know, retail leases tends to be about 10 years is the base. So even with the new discussions that we've had, a lot of it is maybe more concessions or TI, you know, a couple months more free. But the retail rates have held up, all up and down Queens. I mean, it's, you know, certain pockets, downtown Flushing, there's only one downtown Flushing. Downtown Flushing, there's just such a limited amount of supply within downtown Flushing for retail, like prime retail space. That downtown Flushing has performed extraordinarily well. The same with Jackson Heights, you know, Broadway and Roosevelt, that corridor. There's only so much inventory that you do have over there. And even throughout this entire crisis, I mean, credit tenants have paid. Credit banks, they never missed rent. Banks, some of the large corporations, they've continued to pay the rent. So, you know, with the new deals we see, you know, it's, you know, a little break on the front end. Then after 12 months, we'll escalate it up. Instead of doing, you know, it used to be, you know, 3% annual increases. Now we'll find out that the increases tend to be a little bit on the higher side because we're giving more of a discount on the first year.
Kevin, are you seeing, is that what you're seeing in CoStar, or, you know?
So for like my perspective, I'm almost like you guys are like the players on the field, and I'm more like the announcer in the booth watching from afar. So we don't see so many of the plays. So there'll probably be leading indicators as those goes on. But from the transactional standpoint, we're seeing them. The actual nitty gritty of the deals and the negotiating, that's, you know, more stuff we'll see as it bears out. The rents we've seen asking in the market haven't dropped substantially or anything where you couldn't factor out the type of properties that are making up the new batch to say, hey, that's why they're moving. So I think like we'll be able to vet that out maybe in a few months as more deals there. But from a high level, like Jerry said, nothing, you know, large rent drops, no substantial term changes, but, you know, we'll be able to better monitor it as deals come in.
Okay, awesome. That's kind of what I'm seeing too. It's I'm optimistic. I see these things coming together, but I'm not sure if they actually are going to come together. Which leads us to office. What is the state of office? I also feel like that has the most vacancy. I don't want to be a pessimist about it. So what do we do about it? Are these things moving? Are people going to come back to work? Kevin, do you have, is there data?
So, I mean, I checked, there's 180 leases expiring, searches have gone up, there's lease space there. I mean, like, the vacancy going up is higher in the Class A assets, like your marquee buildings. The other ones are up, but nothing, insane. They're up a couple percent. I think as far as like where the world goes, I think there is an appetite for people to go back to work, to go back to the office environment. It may look different in the short term, but they're going to need more space to kind of accommodate the additional there. I mean, we're seeing tons of people searching on LoopNet at higher rates. The interesting thing is like 1 out of 4 people are headquartered outside the market, so we see them on the website looking through pictures, spending longer time on the actual listing. So they're doing research there, and traffic in office has been up across our sites. I think it dropped, right when the doors shut. But as soon as and that's no more than a dip you'd see Thanksgiving to Christmas in terms of searching, but it came up and it's been up. So there's an appetite there and we can see it moving. It's just a matter of it's going to take a little bit for that data to show into closing leases and where it's going to shake out. But there's absolutely people searching in higher numbers than there were before this.
But as of right now, is it the case that vacancy has increased and it's on that trend?
It has. It's increased. It's come up a bit, but it's going to depend on areas. It's going to be pocketed. There's going to be different in LIC versus it is in Forest Hills, Regular Park. It's come up a bit, but it's not. It's higher in Class A. You have Macy's putting the 33,000, the pretty large space, I think, in the Jack C. So there's stuff coming on the market. It's just a matter of does it get, how much it gets absorbed from people moving or expanding space or how it shakes out. I think there's a lot to watch in this area.
Okay. Anyone want to just go in on anything?
Sure. Yeah, the office space I think is going to have the most knee-jerk reaction at this point in time. So that's going to really epitomize the wait and see attitude. Right now, as far as our findings, only 5% of office employees are actually back in the New York City area, which could make these Class A buildings feel like a ghost town. Overall, though, I certainly would agree that we'll continue to see some vacancy increases, but I think overall Queens is in a good spot, and I'm bullish on it as far as people looking for more boutique type of space or the hub and spoke type of idea where they'd like to be a little bit closer to home or spread out a little bit more. There's not a lot of Class A buildings in Queens, and it really is more of a boutique type of feel. And I think that you'll see more new construction in Queens catering to what we think the new office market will be. Whether you see smaller floor plates, private elevators to private elevator stops to your floor deck and things of that nature. So I think overall, in a longer term effect, I'm bullish on what could happen as this new market and the office evolves for Queens.
Wonderful. We're at 3. I love doing these moderations. I'm not really sure if I did a good job this time because it's just like so much stuff and we're just kind of just hitting it as good as we can. Does anyone want to just kind of say anything about the market right now that we didn't touch that you think is important?
Yeah, I think there's one thing that's also very important to kind of note is that the kind of population, the people that are moving into Queens, they are younger, but more importantly, what we've seen is that they're also highly educated, which is something to keep in mind. Is that, I mean, these are working professionals. A lot of, we see a lot of working professionals coming in. A lot of them are looking for space and flexibility. The big thing is they don't want to, they want to be able to commute into the city for work, but they also want to be able to commute out to the, out to the island or upstate. And they're looking, and what we've seen is that a lot of them renting 2 places, one out in the, out in the suburbs for a weekend place. And they're also renting out places in the city now, which is kind of ironic. And, they find Queens to be interesting because it's a combination of both. You do have the large parks, huge amount of natural parks that exist in Queens. And also at the same time, the value of the product in Queens, and that's why it's been so attractive up and down the line, in investment sales, in the storage industrial space, is that the value of the product in Queens is probably the best within New York City. You know, you have Amazon taking an additional warehouse space. And what people have to realize is once they take warehouse space, it filters on down the real estate cycle. You need more housing. And with housing, another area that we haven't covered today is also academics, schools. We get a lot of school inquiries. Schools are looking to expand space because the population itself is also expanding slowly within Queens.
Agreed. I think overall, when you compare it to Manhattan and Brooklyn, the price per pound to play in Queens is a lot less. Jerry did a great job touching on a lot of the diversity. We're home to 3 of the top 5 diverse by background zip codes in the entire country. You know, we have 13% of all the qualified opportunity zone tracks in all of New York State. And I think that Queens will be one of the leading indicators and one of the boroughs that are really going to, you know, come out of this downturn and pandemic a lot stronger because of all those factors.
Yeah, I'm getting that feeling that it really is Queens' turn to shine. You know, Brooklyn had its nice run, and I think I'm optimistic about Queens. So I'm looking at the Q&A questions, and I think we touched on most of these. Jerry, I see you responding to people. Thank you so much for that. And there's a couple of specific questions about lease negotiations and things like that. Feel free to reach out to the Queens Chamber and ask to get connected with someone. We'll be happy to go over it specifically. I don't think you want us to kind of talk about it in front of 100 people right now, so we'll do that on the side. If that's it, that's it. Any more questions? Any more comments? All right, so sorry, go ahead.
Good job, Michael.
Thanks.
Great job, Michael.
So thank you everybody for coming. We're gonna run more of these in the future. And yeah, reach out to the chamber if you have something that you want us to go over. You know, maybe we'll make a topic just for you. So thanks for everyone for attending.
Thank you all. Good to see you. Be well.
Thanks, everybody. Bye, guys.